The Fed is now the largest investor on the planet. That's right, the Federal Reserve has their tentacles so far into the economy, they are the largest investor on the planet. I'm actually extremely concerned about that. I'm going to give you some implications coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Welcome to this channel. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so here's the deal. We've had our 1 hour talk show, radio show for 5-6 years now, but it's just been over the past few months since the pandemic started that I've been doing these daily videos to you, and I could be wrong, but I think this is the most important one that I've recorded to date. And it has to do with the overall monetary policy that we find ourselves in right now. And I'm going to focus on the Fed, but it's really not just the U.S. central bank, the Federal Reserve. It's all central banks that are doing this. You know, I had a comment from a fan of the show make a reference to a few videos back about how the U.S. market and U.S. Federal Reserve is turning into what happened in Japan back in the late 80s, that propped their stock market and pushed it way up, and then things dropped and it's never really recovered. And it was some mistakes with monetary policy. I'm not ready to take it that far, but I'm extremely concerned about the long-term implications. So here's the deal. The Federal Reserve, leading up to the 2008 financial crisis, was managing their balance sheet and had less than $1 trillion out there in circulation. I don't have the dollars right in front of me, but let's say, $800 billion. Well, they needed to stimulate things and stabilize things for the most part going through the 08 and 09 financial crisis. And so they took their balance sheet and just about doubled it. Took it from, about 0.8 to 1.6 trillion. Well, as you know, here's where I'm going. As you know, getting out of the financial crisis, the Fed didn't just stabilize things and then get out. They had to continue doing what was called quantitative easing. They needed to continue to inject money into the system in order to keep from the markets completely crashing and falling. And so the Fed took their balance sheet from 1.6 trillion up to 2, up to 2.5, up to 3, and every time they tried to back away, the market would fall. And they would capitulate and say, no, we're going to do QE3 and QE4, and then it turned into QE infinity. Now, enter fall of 2018. Fall of 2018, the Fed started saying we're going to unwind what we're doing. We've slowly increased interest rates, but we're going to unwind what we're doing. And the markets had an enormous sell-off, extremely quick. And if you look from a magnitude standpoint, it wasn't nearly as severe as the fall of 08. The fall of 18, the downturn was, but I mean, it was swift, it was scary, and the Fed said, no, just kidding, and they lowered rates, and they continued to quantitative ease, and so on. And so we found ourselves entering into this terrible economic storm of this pandemic in 2020 with the balance sheet for the Fed about $4 trillion. And what did they do? They had to, or they chose to, one of the two. They moved it up to $8 trillion. Guys, a decade ago it was less than $1 trillion. Now they've got $8 trillion, and they said in order to stabilize things, we're going to be buying securities, we're going to be doing all sorts of creative things on top of dropping interest rates all the way to zero, but the interest rates weren't even that high to begin with. So we couldn't drop them that much, although just to get them down to zero. And we're going to take all sorts of unprecedented measures. And Jerome Powell said, we've got all sorts of ideas, all sorts of ways that we can stimulate the economy, okay, outside of the conventional ones. And so the markets love that. And the balance sheet continues to go up for the Fed. And many people are thinking it's going to be 10 or 12 trillion by the end of the year. The Fed now has 23,000 different securities, according to Bloomberg. They're the largest investor. They own individual securities. They are buying assets faster than what you can really imagine. And then they come out last week And they said, we're actually going to try to create inflation here. We think inflation's been too low, it's been trending too low. We're going to try and create inflation. Here's my question. How in the world does the Fed ever get out of this? How in the world has the Fed has inserted themselves so far into the financial system? How do they ever get back out and let it function normally? Let it function on its own? We used to say it's life support, but do we now have a pacemaker on this thing? Are we fully on artificial intelligence? Is the Fed really the one that's operating the economy, and we're more of the secondary individuals? I don't see how the Fed is so far deep and how they actually get out without creating a crash. Because every time they tried to, after the longest recovery in history, every time they tried to get out, the market would have a spasm. And it looked like things weren't stable enough for them to do that. So let me make a leap here. The Fed has said we want inflation. What happens after we get inflation? Well, they've said they'll be raising interest rates. Well, that's what happens. Interest rates, they're going to let inflation run for a while, and then they'll be raising interest rates. And the Fed has actually said that would give them more ammunition for the next downturn. We'll be able to reduce interest rates. So let me make a leap. What if the Fed is saying we're going to continue to inject more and more and more and more and more and more and more money to get inflation, enforce inflation, and create a bubble to justify us raising interest rates so that as we start backing away, we know the market's going to absolutely hate it and the market's going to crumble, and we'll at least have interest rates higher and we can start reducing interest rates, and hopefully that will pacify the system. What if the Fed is looking and saying, we are so far into this manipulation, there's no way for us to get out without creating a crash? And the best way to get out and deal with the crash is go with conventional measures of stimulating the economy when there's a crash, which is interest rates. So let's create inflation to raise interest rates to then try to start unwinding. If that's the case. I know I'm making a leap here, but guys, the free market should be able to function without this much intervention. And we've actually been on a pattern over the past 12 years where it's no longer some stimulus, it's actually the stability that the Fed is offering. And they're so involved. I don't know if the economy can operate the way it's supposed to without the Fed being so involved and being the piece that stabilizes things. So what does this mean for you? Number one, get used to interest rates being low for a long time. The Fed has said we're going to create inflation. They need to let inflation run before they'll start raising interest rates. So get used to interest rates being low. Figure out an adaptable strategy for your bonds, a different way to get income. Work with your CFP on that. 2, be very, very, very careful if we see another economic downturn before the Fed is actually able to create inflation. If this V-shaped recovery actually doesn't fully form, if it becomes a W, something like that, we need to be very, very careful. So make sure your investment posture and your overall financial situation is adjusted for that. 3rd, you've got to make sure that your investment strategy and really your entire financial life is set up potentially for a bubble and burst type of scenario. I mean, the Fed's basically come out and said, we want to create a bubble. We want to create a bubble. And if you're sitting on the sidelines and are too timid or careful about how high things are, like I am, and you're not participating in that, it's very possible you could miss out on a big rally. But if you're just blindly doing that, it's very possible you're exposing yourself to some new risks and some greater risks than what we've seen in the past. I don't want to be an alarmist here, but make sure that your investment strategy has a way to capture upside and protect the downside. Our momentum, our dynamic strategy offers that. And then connected to that, make sure your financial life, your entire financial life, not just one area of your financial life, your investments, is set up to do just fine in a bubble and burst scenario. Yeah, that's right. Make sure you've got an emergency fund fully funded. Make sure you're not overextending yourself with debt. Make sure you've got the right protection in place. Make sure you've got a budget. You know how much money's coming in, where it's supposed to be going. Make sure you've got all of your entire financial situation, all 6 areas. You're making principle-based decisions in those, just in case we see a bubble and burst created by the Fed. Work with your CFP on that. As always, if you don't have a CFP in your life, we'd love to help. You can find our team of advisors at korhorn.com. That's Korhorn with a K. Also, wisemoneyshow.com. You'll find us there as well. And then lastly, you can always give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.